All right. Is anybody going to buy that one low? I don't think a lot of traders will buy it. It's far above the moving average, far above the gap, and it's a bear bar, and it has a big tail below. So all of those things make traders not buy that one low. For the bears, they now have a two-bar reversal. We gapped up, we went down on one, up on one, now down on two. It's a possible high of the day, but the doji on one and the small bar on two will make a lot of the bears hesitant to sell. Are we always in short? I think we're always in short. We have consecutive bear bars, and one of the bear bars is closing near its low. But the problem, obviously, is the bars are small. So there's not a lot of movement. There's not a quick move down from this price level. There's no evidence that this price is horribly too expensive and that we have to race down to a better price. A lot of traders sold the close of one because it was a bad buy setup. You have a doji bar with the gap up, not good, and then you have a bear body, and you're far above the moving average, and there's room down to yesterday's high. Remember, over the past couple of weeks, we've had several times when the market sold off early. A couple of days ago here, rallied a little bit, sold off. And this is new, sold off, right? This is new over the past couple of months to get early selling. Bulls don't mind the selling. They're hoping for a reversal up from support, like the daily measured move target or yesterday's high. Not a lot of traders are going to buy above 3 unless it's a fairly dramatic bull bar. Maybe a 3 or 4 tick bull body closing on its high. That means we're probably sideways to down at least for another bar or two. So the bull's opening reversal, but 3 bars without a bull body. Probably and I think we're always in short, so not a lot of bulls are going to buy above 3. I think more likely sellers above 3. However, if the bulls get a big bull trend bar here, that will change things. But right now, more likely sellers above. Four bars without a bull body. But like yesterday, unless you get consecutive decent sized bear bars, the odds are the sell-off is probably a leg and a trading range rather than the start of a big bear trend day. The context is really good for the bears. So we're always in short. But doji bear bar, instead of consecutive relentless selling, increases the chances that we're going to stabilize soon. Will traders buy the close? Arguing that the gap above yesterday's high will stay open. We have 4 bars without a bull body, and we're not quite down to the support of the moving average, and therefore I would not buy the close. And if you're selling the close, I think selling the close of 2, selling the high of 3, okay. The bears are trying to get a gap below 3. We're always in short, but this is not a great sell. If you sell it, stop above 1, and you probably have to be willing to scale in higher. The lack of consecutive big bear bars reduces the chances that we're going to have a big bear trend day. Okay, important. It looks trivial, but it's important. If 5 gets above the 3 low, especially if it gets 2 ticks above the 3 low, that would significantly reduce the chances that this is the start of a big bear trend day. And for the bulls, it's a high 2. Okay, there you go. 2 ticks above the 3 low. All right, there's a problem with the sell-off. For the bulls, it's a high 2. It's actually a tiny parabolic wedge. We're going down on 1, up on 1, down on 3, up on 3, down on 4, trying to go up on 5. So it's a tiny parabolic wedge. And just like 1 is a possible high of the day, 5 a possible low of the day, but 4 bars without a bull body, not a good stop entry buy.
You have to read this thing. Okay. Yeah. Because of listening to what happened. I wish. That's why I still give them what?
Good. So what do you do here? I would wait right now if you did not take any of those early scalps. The 1 closed, the 2 closed, the 3 high. Suppose 5 is a great looking bar, totally reversing 4, closing on its high. That would make it a reasonable candidate for the low of the day, but I would wait to see if we go sideways and get some kind of a double bottom. Nothing has changed. Monthly chart, 12 months without a pullback, very overbought, and the weekly chart, 48 weeks without touching the moving average. It got close here but did not touch, so also extremely overbought. But until you get a top, climaxes can keep growing and growing and growing. The rally can go on indefinitely, although right now it's historical. You know, it's never been this overbought on both the weekly and monthly chart. You know, 1995 it was, but that was it in the past 50 years. There's nothing similar to this. And therefore, it's not likely to continue much longer without getting a pullback. So bulls now have a high 2 and a tiny parabolic wedge pullback, but only 1 bull body on the first 5 bars. So a lot of traders will not buy it. They'll wait to see if 6 and 7 are bull bars closing on their highs. The bears know this is a bad bar for the bears, so they're selling here, trying to prevent the market from getting above 5. They know a lot of bears will give up if it gets above 5. Speed mic. Testing.
Yeah, I hear you.
Okay. Well, I just spoke with one of the organizers of the room, and he said the sound has been out. It must have been related to that Windows update that I did. I don't know. But anyway, I can see the sound is back on right now, so I'm sorry about that. Let me start back to where I was. Let me start the day over again. First part of the day, a bear doji. Probably sellers on the close because bulls are not going to buy up there, and there's room to support. So they sell the close, bar 2, a decent bear bar, that's sell the close. And then bar 6, you can argue high 2 with bar 3, but only 1 bull bar and 6 bars plus room to the moving average. So probably sellers above. And not a good stop entry short below 7, a doji bar. We have a bull bar here. So if you take the short, you got to be watching for a reversal up. Bar 8, a big bar, but is it more likely the start of a bear trend or an exhaustive end of the bear trend? And we got a small reversal up on 9, a 1-tick bull body. We can call it a high 3, 1, 2, 3. You can call it a wedge, 4 reversals up, 1, 2, 3, 4. Possible low of the day, but only a 1-tick bull body, tight channel, probably a minor reversal, which means that the first rally will probably be limited and we'll probably have to test back down. We got the double bottom on 24, but a fairly big bar, forcing traders to buy fairly high up in the range. Possible low of the day. We're after bar 18, so that means that 90% chance we've either seen the high or low, and now we're getting a double bottom at the low, and we did not get below the 9 low, and therefore we'll probably try to get above the high of the day. The rally up was weak Stop entries, not great, buying above 31. And then when you start getting up here, the minimum target is 1 tick above the high of the day. And if you're scalping for 1 point, you have to enter at least 5 ticks below that target, 1 tick above the high of the day. So buying with stops up in here is getting tricky. You can see we went 1 tick above a couple of times and did not get follow through. Got a small reversal, 58. Made me think that we might get down to the fulcrum all day long. This has been the key price. Don't you think it's interesting on the daily chart that, at this point, at this instant, daily chart, we have a major higher low, we have a strong reversal down, we have a breakout and then a pullback that just dipped a little bit below support, reversed up, and then started to accelerate upward. So that means that this point is very important. This point is obviously very important, a major higher low and a bull trend. That means that a measured move up from those 2 points is important. And, I think it's fascinating that on the 5-minute chart, the market has been oscillating around this price all day. So day traders are paying attention to this target on the daily chart. The market is, right now the fight is over the close. Will the day close above its midpoint, being less bearish, or will it close below the midpoint, being more bearish? The bears would be better off if today closed on its low. We have a wedge on the daily chart, 9-bar wedge after a buy climax, normally a minor reversal, but given how overbought the weekly and monthly charts are, this has a higher probability of being a major reversal. So if we start to reverse down, what's the chance that it could be a big reversal down to the breakout point? I would say 40%, but the bears need to start to get a reversal down, which they do not yet have. Weekly chart, 48 weeks without touching the moving average. It will not touch the moving average until at least 49 weeks. The E-mini has never done that. It's never stayed above the moving average for more than 48 weeks in its 19 or 18-year history. And monthly chart, we have 12 bars without a pullback. And the S&P cash index has not done, it's only done once in 50 years. That was 13 weeks, and then had about a 10% pullback. So right now we're at the outer limits of what the stock market has ever done. While it can do more, it's probably not going to do much more before it starts to do what it always has done. So I think we're going to pull back on the daily chart, at least to this breakout point, which is around 2,500. And I suspect that we'll pull back more, maybe 100, 150 points. This major higher low area would be another magnet, but no reversal down yet. And until you get a reversal down, it can go a lot higher. Also, 60-minute chart. This looks like a channel in what will become a trading range, which means that if we do start to get a sell-off, we'll probably bounce here for a day or 2 or 3. And then, maybe we'll get a head and shoulders top, left shoulder, and then a big head, and then a bounce, and then a right shoulder, a lower high, major trend reversal. Bulls tried today to get a breakout above the bull channel and failed. Stop entries today, very few reasonable ones. Above 9, probably a minor reversal. Above 24, swing trade for a new high. And same with above 31. But up here, you got to be careful. Buy the close, sell the close. Not good buy the close, sell the close at all, except aggressive. Sell the 1 close, sell the 2 close, sell the 3 close. And then here, maybe buy the 35 close, betting that the bears are giving up and we're going to get above the high of the day. And then beyond that, it's limit order trading. Traders buying bear closes on the way down, selling bull closes on the way up. And limit orders, even limit order trading was not good because the range was so small. Anyway, I'm getting emails about the audio problem. I didn't realize it. In the future, if there's an audio problem, email on one of the administrators, and he can check it out, and then he can contact me, and we can try to fix it. GoToWebinar, I think, is not very stable. And then today, Windows did that massive update. I have not restarted the computer, but I suspect that either GoToWebinar or that massive update did something to make the microphone switch. There's an internal microphone on the computer, and I use an external microphone. And when I just checked the mic setup, it had reverted from the external, which I use all the time, to the internal. And I don't know why I did that, but it did. So anyway, in the future, if you see the mouse moving around like this and you're not hearing me talk, send an email to the administrator, and he and I can try to fix the problem. Limit orders today, probably sellers above 3, probably buyers below 13, and then really tough in here. We have a double bottom here, neckline, but we're probably going higher. So a lot of the bears will not sell here, but they might sell 1 or 2 points higher. And you can see the breakout above 1. Some bears would sell with a limit order. Others would wait to see if there's an absence of a big bull trend bar and then sell. And that's what happened. After 2 bars not being a big bull trend bar, traders sold with the limit order. And this rally was likely to be a lower high, even though it had 5 bull bars. Once we started to get the pause bars, we have an obvious magnet below. That was an okay limit order sell. The day ended up very small, 4.75 points. And we've had a number of small days here. And this is unusual behavior, historically unusual behavior. And usually what happens is all the high-frequency trading firms, all the day trading firms, start using algorithms that work with this kind of environment, small ranges, limit orders. And if enough of them, once a critical mass of them, once enough of them all start doing the same thing, there's no one to take the other side of the trade. So if they're trying to sell high, there's no one willing to buy. And, it becomes tougher. They sell, they're trying to place limit orders to sell, and there's no one willing to buy. So they can't get filled. Eventually it blows up. Their systems are no longer profitable. If you're looking to sell, someone has to be willing to buy. If you're looking to buy, someone has to be willing to sell. And if everybody's trying to do the same thing, all of a sudden, your algorithms stop working. And what happens is you switch from a very low volatility environment into a very big volatility environment. If you've only been trading for a few months, what you have seen, you're going to assume is normal, and it's not. And it's very unusual to have this many small trading range days for such an extended period of time, and it's not going to continue. And when it changes, everyone is going to be in denial, because it's natural to assume the market will continue to do what it has been doing, small days, an occasional big day, but mostly small days. But that is not going to continue. We'll start to get a series of very big days, and I think big days down is more likely than up because of how historically overbought the weekly and monthly charts are. Okay, all the questions have to do with the sound. Okay, question. Would 18 be a better low 2 setup if it had not broken the 17 low? Okay, 18. No, in a small trading range day like this, he's saying, would it be better if the 18 low, the bear bar, was not below the 17 low? It might be better, and also better if it didn't have the 1 tick tail. But in a trading range day, nothing as good as you want. You have a double top bear flag, and you have a wedge lower high. 3 pushes up, 1 pull back, 2, pullback 3, and we've had lots of reversals, small bars, a lot of trading range price action, and therefore you have to assume every setup is going to have something bad. Okay, buying above 9, only a 1-tick bull body and a tight channel, bad. You're selling here, you got a bear bar, not all that big, and a tail below, and then buying here, you get a very big bar, and that's just the nature of trading range days. There are just not as many. The setups they don't look as good as you want them to look, and also they never go as far as you want them to go. So most traders are scalping with limit orders and not taking very many trades, especially when the market was mostly in a 2-point range here. Back to the question. With the market so climactic, presumably on the daily, weekly, and monthly chart, it has the feeling that we're walking on thin ice, and a huge breakout can come at any time. That is absolutely right. That's another metaphor for what I've been saying about momentum bulls. I saw a guy on Fast Money. Maybe I don't know if it was on Fast Money, or maybe I just read it on the internet, and he was making the point that you're not buying because it's cheap. You're buying because you have to buy. If you're a trader, the market's going up, you have to buy. Everybody knows it's climactic, and nobody's buying because of value. You have some stupid people saying the market's cheap, and they're buying because of value, but they're stupid. The market is not cheap. It's clearly expensive. Look at the monthly and weekly chart, and most of the traders buying up here are buying for one reason: the market's going up. They're not buying because the market is cheap, right? And if you're buying because the market's going up and it stops going up, what are you going to do? It's your thin ice analogy, right? You're going to quickly sell. And so if the market starts to go down a little bit, even right to here, then all the traders who bought in the last 8 days are holding losing positions, and they know it's a buy climax on the daily, weekly, and monthly chart. What are they going to do? Are they going to use a wide stop down here, or are they going to say, maybe I should just get out? And what can happen is you suddenly get everyone selling out because they bought too high, and they know they were buying a momentum market, and now the momentum is gone, and they're holding losing positions, and the result can be a very quick sell-off. And the day that it happens, there will be a news event. Trump did this, or Pelosi did that, or North Korea or Iran, or the Fed, or some stock did something stupid, and everyone's going to say, oh yeah, it fell because Apple did X, Y, or Z, or that's wrong, right? That might be a catalyst that gets people selling initially, but the sell-off will come because the market has gone too far up, and it usually has to go too far to find out how far enough is. So if it's gone too far, then far enough is well below too far, and that means it has to quickly get down to a more reasonable price, so you can get a very quick reversal down. Okay, no top yet, extreme buying. They keep putting these bulls on TV. I don't know if you've been watching, but they keep putting bulls on who keep saying, oh yeah, this is fabulous, we're going up, 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 right? And once we drop 100 points, you know what they're going to put on? Bears. Those bulls who have been on for the past few months are going to disappear. And that's just the nature of television. When the market's going up, they put on the bulls and they tell the bulls, oh, you're so smart, you predicted this. And then when it goes down, they put on the bears and they say, oh, you're so smart, you predicted this. And it's just sampling, right? At any given time, about half of people are bearish and half the people are bullish. And when it goes up, they only show you the bullish half. When it goes down, they only show you the bearish half. But when those bears are on TV, the bulls are still alive and they're still buying. And when the bulls are on TV, the bears are still alive and they're still selling. So you cannot rely on what you see on television. All right, so it's still going up. odds are we'll keep going up. However, it's so overbought, and now we finally have a credible topping pattern on the daily chart, but we don't yet have a good sell signal bar, and we do not yet have a big bear reversal down yet. So I'd still favor higher, but I think that we're probably within weeks of the market beginning a 100 to 200 point correction, but we'll see. I only say that because of how historically overbought the weekly and monthly charts are. And then you add to it what I said the other day about the end of the year. If we were looking at a yearly chart where every bar is 1 year, this bar would be a big bull bar opening on its low and currently at its high. Most bars have tails on top, which means some profit taking before the end of the bar. And that means some profit taking before the end of the year. So in the final 2 months, we'll probably get some profit taking. And as I said, we could easily pull back 150 points between now and the end of the year, and then retrace 100 of it, and then the year closes 50 points off the high on a yearly chart. So a small tail, but it will not be showing the 150 point sell-off that took place, right before the close of the year. So to me, it seems logical that we'll get 100 point or more pullback between now and the end of the year, simply on the basis of what I said. Even if you have a big bull trend bar like we have on the yearly chart, there's usually some profit taking at the end. Okay, hope everybody has a good night.